Welcome to the trendier version of Kafesito with MommaKat. Today I have the pleasure of giving you guys an awesome video with two of my favorites in the mortgage industry, Team MD from Caliber Home Loans. We have Danny.
How are you, everyone?
And we have Mike.
Pleasure.
And they are the best team out there when it comes to financing. So today we're going to ask them some questions and bust some myths regarding the financing world. So my first question to you guys, which I get all of the time, is I want to purchase a home and I've been told that I need to have 20% of my down payment already in my bank account to buy a home. Is that true?
Well, I'll take this one. That's a very common myth in the marketplace right now. A lot has to do with the media, letting borrowers know that you have to save up for 20% down, which in some ideas, yes, that is true, but not necessarily. First-time home buyers do not have to come up with 20% down. They can come in with as little as 3% down, and I find that more than often than customers think, oh, I don't need 20% down. I'm like, no, absolutely not. You can go in as little as 3% down. And also there's a lot of other programs out there as well that can help with down payment assistance and so forth. So we always have to educate our agents and our buyers, letting them know that there's many opportunities to be able to get a home with less than 20% down. So that's definitely, absolutely a myth right off the bat.
Another question that I get, and it is very confusing for consumers, is MI. So in, I would say, basic terms, financing for dummies per se, what is mortgage insurance and why do some programs carry it?
Well, mortgage insurance is basically what allows you to put less than a 20% down payment. That's the reason that mortgage insurance was created. So mortgage insurance is included on practically every single loan that does not have a 20% or more down payment, except for VA loans. And it's just an added factor to the housing payment. So the housing payment will consist of principal and interest, taxes, insurance, mortgage insurance, and if the property is a condominium or a townhome, it will have HOA as well. So mortgage insurance is essentially what allows people to put as little as 3% down, 5% down, etc. And mortgage insurance is based on your credit score and how much of a down payment you're actually putting on the home. So someone that has a 780 putting a 10% down payment will have a lower mortgage insurance payment than somebody that has a 680 credit score that is putting a 3% down payment. So that's basically and essentially mortgage insurance in a nutshell.
And just to piggyback off here, what mortgage insurance is basically, it's a protection for the bank that, God forbid, the house was to go into foreclosure and it goes through the process of the foreclosure, that mortgage insurance helps recuperate the loss from the lender. So that's another reasoning of what mortgage insurance is that a lot of customers ask, what is mortgage insurance and why do I have to pay it? So that's basically what, also to piggyback on what Michael said about what mortgage insurance is.
Perfect. And so another question I get, once I already purchased my home, let's say I purchased my home and I do have MI, and I've been living there for 5 years, and I'm interested in refinancing to remove the MI. Is that even an option for me?
It is, depending on the market. And the reason I say depending on the market is because if you purchased your home when interest rates were 3.5%, and you have a fixed 30-year mortgage with a 3.5% with mortgage insurance, that payment may be lower than a 4.5% without mortgage insurance. So it all depends. The goal of refinancing is essentially to lower the housing obligation or the monthly payment. And if the market allows you to do that when you have enough equity to remove the mortgage insurance, then it makes sense to refinance. Nevertheless, If you do not want to refinance, but your property, if it doesn't make sense to refinance, but your property has 20% equity, you could contact your lender and begin the mortgage insurance removal process with your lender directly, and it will not require that you change the interest rate of the loan whatsoever. And that would be the most beneficial way of going about it, because it doesn't require closing costs, and you get to keep the interest rate that you got whenever it was that you purchased the home.
Mm-hmm. Yeah.
Good answer. I didn't know that. See?
Now, if you have an FHA loan, the mortgage insurance will be on there for the life of the loan. One thing that you have to keep in consideration with FHA is that every year, the mortgage insurance, every 12 months, the mortgage insurance is going to be recalculated based on the balance for the next 12 months. So after you've paid principal for the first 12 months, then the mortgage insurance is recalculated, and you pay a different mortgage insurance for the next 12 months, and so on and so on. So if you've had your FHA loan for 5 years at a 3.5% interest rate, it may not make sense to get it into a conventional loan just for the purpose of removing the interest rate. The mortgage insurance.
Awesome. So staying on the topic of refinancing, I actually had this question asked yesterday. I have a friend that recently did an appraisal on their property, and they realized based on their loan payoff that they have around $150,000 in equity, and they would like to pull out those funds and purchase an investment property, but they had a misconception that they couldn't do the financing for the investment property, that they had to pay for that property in cash.
No, not necessarily. That is not something that will have a detriment for the client. As long as you're pulling out the money to buy another property, you can use those funds for the down payment. Okay, and then when you're buying that investment property has a rental income that's going to be generated from that. So you can also use that rental income to help you qualify for the purchase of the investment. So I have clients all the time wanting to pull money out of their properties to go ahead and buy another property for investment or for a second home. So definitely you can do that all day long. There's other clients as well that will do a home equity line of credit. They'll do a second mortgage on their house, have a line of credit, and when they're ready to buy it, they're going to use on what they need. So you can definitely, that happens all the time. You can always pull money out of your property to buy your next home, or even if it's enough equity that you have, you can actually buy it cash if it's enough. So, but if you don't, you can definitely get another loan to go ahead and buy your other investment property with. As long as you qualify and you have the income and the credit is fine, you should have not a problem at all getting them.
Yeah, so there's absolutely financing for investment purchases. Now, investment purchases do require a higher down payment than a primary residence. So an investment purchase will require a minimum down payment of 15%. And it sometimes doesn't even make sense to do as little as 15% because the interest rate ends up being very high in a 15% investment purchase. So most clients end up doing 20 to 25%. But to piggyback on what Danny said, I recently had a client take out a home equity line of credit for $100,000 on their primary residence and use $65,000 of that $100,000 to put a 20% down payment, a 25% down payment to purchase a duplex. And when they took out the home equity line of credit, that they were afraid their debt to income ratio was going to be increased and they were no longer going to qualify. But the duplex does receive rental income from each side, so that was able to offset the additional debt that they acquired by taking out the home equity line of credit.
I'm so glad you brought up duplexes. It's like you're in my brain, right? So that's another question. I get a lot of questions. People like to ask me questions and I like to give them answers, and that's why I consult with people that are truly the best and truly know and want the best for their client, because that's really important. They don't try to put you in something that they know that you can't handle or that you can't meet on a monthly basis. That's not the purpose of what they do, which unfortunately you will find people out there that will nickel and dime you to get you into a property that maybe doesn't make sense for you financially, and you won't have that problem here. So regarding duplexes, I have a friend that she's considering a duplex in the Grove for herself, and she wanted to know if she purchases the duplex, can she use the rental income from the other unit to help her qualify for a higher loan amount?
Absolutely. Before we answer that, your top is about to come off, so trying to avoid coffee disaster. Trying to avoid one here. We almost had that happen to me before we started videotaping, so it's only
Stay
right.
tuned for the bloopers.
Stay tuned for the bloopers. It's only right that I return the favor, right? So, absolutely. To answer the question, she absolutely can use the rental income from the other unit in order to qualify. So when it comes to duplexes, a client will qualify for a higher purchase price on a duplex than they will on a single family residence. And the reason being is because we could use a portion, not 100% of it, but we could use a portion of the income being generated by the other unit to help them qualify.
Yeah, and one other aspect which is intriguing as well, when you're buying a duplex and you're going to live in one of the units, with FHA, you can go in with as little as 3.5% down.
Just about to ask you that.
Because conventional financing requires a higher down payment. So with duplexes, you don't have that issue no matter what purchase price it is. You can always go in there with 3.5% down, and a lot of people are doing that these days.
And if the unit isn't rented right now, but I plan to rent it out, can I use that income for purposes of qualifying?
Absolutely, you can. One of the things that is obtained during the purchase of a duplex or what is called a multi-unit property is this appraisal report called a rent schedule. And that rent schedule is going to let us know how much that other unit could rent for and what's the average rent for those type of units in that area. And we could use what is listed on the rent schedule to help you qualify as well. So even if the unit is not rented, then we could use the income that the appraiser says the property can generate to help the buyer qualify.
Ooh, really good. I like it. Good tips, guys.
No problem.
So I have another question for you. Another question that was asked to me. What is truly the worst case scenario regarding my credit? Some people have heard 540, some people have heard 580, some people have heard 620. If I want a good deal, I always tell my clients that, it's all about timing. So maybe buying right now isn't the time, but working with somebody, lifting your credit, making sure your ratios are good is a better option. What are your suggestions to people that are right there?
Ideally, depending on their scenario and their financial situation, ideally you want to see at least a credit score above a 660 to get an average interest rate. And if those borrowers that are below a 660, once we've done a couple of scenarios with them and see if it makes sense, it may make sense at that particular time. They may be paying less than what they're currently paying in rent. But for those that are on that border and they may not be prepared, ideally we go ahead and help the borrower. We put them on a plan. We help them with credit repair if anything has to get repaired on their credit report. So we pretty much prep our clients to get to that home ownership time. So it's really important that we do a consultation with them. We provide valuable information to them. And there's been times that maybe we could do the loan, but maybe for their financial aspect and for the best of the client, we tell them let's wait, let's try to raise your credit score up, let's save a little bit more money, so then down the road they're prepared and they're going to be able to get a better interest rate and a better deal for their mortgage.
And another thing is, at the MD Mortgage team, we've come up with some strategies that will help you negotiate the contract in a slightly different and unconventional manner that will allow you to get a below market interest rate regardless of your credit score. So if your credit score and the interest rate that your credit score is qualifying you is the only thing holding you back, I advise that you speak with us because we do have some strategies that will help you get a lower lower credit score than what you qualify for without any additional out-of-pocket cost to you. So that's something that's a little secret of the trade that we have generated and use very successfully here at Caliber and in the MD Mortgage team. So if that's something that you guys are interested in, feel free to reach out to us.
That's some great info. I am so educated today. Mind blown right now. So before we wrap it up, as you know, our biggest clients are actually realtors. So you guys are like me. And I believe education for our realtors is key to their success. It is the most important part of them being successful. So why should an agent choose you guys, Team MD, over all the other organizations and teams out there?
Well, we have I would say mantra or a business model that we follow, and that business model is educate, communicate, and execute. So I always say it's easy to be successful in this industry, because if you educate your clients, you communicate, and you execute on what you've educated them that you will do, then you'll be able you'll be able to thrive in whatever company or organization or setup you have going. So that's one of the things that we do differently, is the amount of education that we provide to the clients, the amount of communication that we apply to all parties throughout the entire transaction, and delivering on the results, delivering on prior, on closings prior to the closing date stated on the contract. And I mean, one thing that we really pride ourselves in, that Danny and I, is that our pre-approvals are kind of like cash. There's very, very, very rare scenarios where when we pre-qualify a client, once the client has found a home, an issue comes up where the client does not qualify. And typically when an issue does come up, it's property related, whether it's title, whether it's condominium, or whether it's appraisal value issues. Typically, once we've reviewed the credit, income, and assets, that aspect of it never has a problem during the loan process. And that's all that we could control at the time of pre-approval. We take a great deal of pride in that.
Yeah, and we're very thorough on what we do. There'll be times where if it comes to any type of income calculation, I typically don't want to go ahead and provide the approval ASAP unless I have to have certain questions answered about my income, because I want to find those things out now rather than later. So we do a lot of homework up front before we provide the approval letter, because like what Mike said, we strive on making sure that when we do issue that it's a solid approval letter. And like he said, we're constantly communicating with all parties involved, and that's a lot of our success, and a lot of repeat business that we do get is because we're constantly updating clients, updating the referral sources, letting title companies know what's going on. So we're pretty much like the quarterback of the whole team, and we're always, without a doubt, scoring touchdowns, constantly.
So many things we could trademark today. It's just blowing my mind. I'm a behind the scenes girl, so I do title. So I see everything almost in the same eyes that the client sees it, because everything is being filtered through me. And I can tell you that the number one complaint I receive in this industry is communication. And I can vouch for both of them, where I can tell you that communication is their strength. They have no worries in picking up the phone and calling you, which people don't like to do nowadays for some reason. They'll text you, WhatsApp you, email you. There's no reason not to get a hold of them, and that's really why I refer them as well, because I work in the same manner. So I work with like-minded individuals so that our goal at the end is the same. And if you need to contact Team MD and you want to work with Team MD, I'm going to let them give you all of their contact information, and you will be able to hit them up via all communication methods.
Shoot. All right, so on Facebook and Instagram, it's MD Mortgage Team. You'll be able to locate us. Very simple, so really we don't have to say what our phone numbers are at, because as soon as you go into Facebook or Instagram and you look up MD Mortgage Team, you'll have all of our contact information there.
Yeah, so look us up on Instagram, look us up on Facebook. I mean, we have LinkedIn, we have Twitter, and all the handles are the same, at MD Mortgage Team. Look us up, all of our contact information is on there, and we look forward to hearing from you guys.
Thank you.
Thank you. This was an awesome
And then she-
episode. Oh, shit.
Kafesito